You may not say that you'd want that person. You'd like the other kind of person too, maybe, but that's where you make the money. And the degree to which the market got dominated by that is shown on a slide I have here somewhere. Yeah, here's on Oxy 1. If you'll put up the Oxy 1, that shows how we bought what became, well, we bought in 2 weeks, thereabouts, 14% of Occidental Petroleum. And you'll say, well, how can you buy 14% of a company in 2 weeks? And it's more extreme than that. Because if you look at the Occidental proxy, you'll see that the standard names, BlackRock, index funds, State Street index funds, basically, Vanguard index funds, and then one other firm, Dodge & Cox. If you take those 4 entities, and they're not going to buy and sell stock. They've got their own little rules. So they own 40% of the company, roughly. Those 4 firms. And they didn't do anything during this period. So now you're down to 60% of the Occidental Petroleum Company that's even available. So, well, Occidental's been around for years and years and years. Big company and all kinds of things. And with 60% of the stock outstanding, I go in and tell Mark Millard, this fellow that is 30 feet away from Mearsal, and I say in the morning to him, buy 20% and take blocks or whatever it may be. And in 2 weeks, he buys 14% out of 60%. That's not investment. I mean, you're not buying from investment. I find it just incredible. You wouldn't be able to do that with Berkshire. I mean, you can't literally buy. You can say you want to buy 14% of the company. It's going to take you a long, long time. But overwhelmingly, large companies in America, well, all of them, they became poker chips, and people were buying and selling like 3-day calls or 2-day calls, and the more times people pull the handle on the machine, the more money the machine makes. I mean, it's very clear, and overwhelmingly, I mean, where did people go? The investors just were sitting around, and there weren't very many, and the money was being made essentially by a bunch of people gambling on things, and that enabled us in a 2-week period to buy 14% of a business that's been around for decades. And you imagine trying to buy 14% of the farms in 2 weeks in this country, or 14% of the apartment houses, or 14% of the auto dealerships, or just anything, when already 40% were locked up some other place. It defies anything that Charlie and I have seen, and we've seen a lot. But I've never seen that percentage of the American public. Essentially, it was a gambling parlor, and the people that were making money were people that worked with gamblers, and then it declined very significantly. A few weeks ago, you can feel it if you're around it. So when somebody asks a very good question, is why weren't you doing anything on February 20th, and why were you doing it on starting, well, in the case of Occidental, on February 28th? It's because things developed in a way, and in the case of Occidental specifically, they'd had an analyst's presentation of some, I don't know whether it was a quarterly one or what it was exactly, but I read it over a weekend, and that was the weekend when the annual report came out. I read it over a weekend, and what Vicki Hollop was saying made nothing but sense, and I decided that it was a good place to put Berkshire's money, and then I found out in the ensuing 2 weeks, it was there in black and white. There was nothing mysterious about it, but Vicki was saying what the company had gone through and where it was now and what they plan to do with the money, and she'll do what she says. She doesn't know the price of oil next year. Nobody does, but we decided it made sense, and 2 weeks later we had 14% of the company, and we also already had a preferred stock and warrants. And the story of the preferred stock is we paid $10 billion. Preferred stock and warrants, we paid $10 billion for it. And at the end of the March quarter of 2020, we valued that $10 billion for our 10Q. We valued it at $5.5 billion. So we had a $4.5 billion loss, and it would have, the world changed. Oil sold for minus $37 a barrel one day, and now it's quite apparent, I think, that we're very happy. We should be very happy that we can produce 11 million barrels a day or something of the sort in the United States, rather than being able to produce none and having to find 11 million barrels a day somewhere else in the world to take care of keeping the American industrial machine working. Charlie, have you got any comments on that as to how something this crazy could have happened?
Well, it happened. It's almost a mania of speculation that we now have. We have computers with algorithms trading against other computers. We got people that know nothing about stocks being advised by stockbrokers who know even less.
I understand the commissions, though.
Yeah, it's just an incredible, crazy situation. And it's weird that we ever got a system where all this equivalent of casino activity is all mixed up with a lot of legitimate long-term investment. I don't think any wise country would have wanted this outcome. Why would you want your country's stocks to trade on a casino basis to people who are just like the people that play craps and roulette in the casino? I think it's crazy, but it happened, and it's respectable. Not with me, but with other people.
Yeah. Well, and look at what the country. I mean, they formed the New York Stock Exchange in 1792 under a buttonwood tree, and it really didn't seem like that was the eureka moment in America. But just look at what's happened using the system for less than, 3 of my lifetimes. I mean, it's unbelievable. So it's worked. Now, maybe it's worked in spite of itself, maybe the country, but one way or another, America has worked in an incredible manner. Nobody could have dreamt it. Nobody. They'd have hauled you away if you said, in 3 lifetimes, that this place where we're meeting. I mean, it became a state in 1867, but 1789, it asked Ben Franklin or somebody that was walking out of the Constitutional Convention, what do you think the prospects are for Nebraska? It's unbelievable what's been accomplished, and it's been accomplished. The people who encouraged the gambling, they would like to say it's been accomplished because of the we've got these liquid markets and all these wonderful things. Charlie would probably say it's in spite of that, who knows? But the answer is that, well, there isn't an answer. My wife, when they got married April 19th, 1952, we got in my aunt's car, and we started driving west, and we ended up, well, drove all over the West, but one night we ended up in Las Vegas. And there were three fellows out there. Eddie Barrick and Sam Zigman and Jackie Gone. And all three of these guys were from Omaha. And they'd bought little pieces of the Flamingo. Bugsy Siegel had his career ended rather abruptly a few years earlier.
Bad bullet.
It was a stray bullet, undoubtedly. But in fact, there were probably 5 or 6 stray bullets. But in any event, Bugsy was gone, and some people, including 3 guys from Omaha, were in the group. Sam Zigman lived about 2 blocks from where I live now, and he was Stan Lipsey's uncle. Stan Lipsey ran, those of you who follow Berkshire, ran the Buffalo News and was a partner for 40 or 50 years later on. So all kinds of things intersect, but I walked into this casino or a Flamingo. It's kind of a motel-like arrangement. And I was 21, and my bride was 19, and I looked around the room, and there were all of these people, and they were better dressed then. It was a more dignified group than perhaps currently, but they'd flown thousands of miles in some cases, in planes that weren't as fast as the current ones and were more expensive, probably on a per mile basis adjusted. And they'd gone to great lengths to come out to do something that was mathematically unintelligent, and they knew it was unintelligent. And I mean, they couldn't do it fast enough in terms of rolling the dice, and trying to determine whether they were hot or whatever they may be. And I looked around at that group. Everybody there knew that they were doing something that was mathematically dumb, and they'd come thousands of miles to do it. And they were, and I said to my wife, I said, I'm going to get rich. I mean, how can you miss? If people are willing to do this, this is a land of opportunity. Well, it's the way it still is. And the Flamingo grew to be much bigger, and in Omaha, we're very proud of Jackie and things he did. He only died a year or two ago. He became sort of the leader, spiritual leader of Vegas. And like I say, Sam Zigman's nephew went on to save my and Charlie's investment that we made in Blue Chip in the Buffalo News. And it's a very accidental society that occurs, but there's nothing stranger than what has happened in finance. On the other hand, if you go back, perhaps the greatest chapter ever written on the operation of markets, particularly the stock market, is in a book that probably one of the most famous books in economic history, the General Theory, written by John Maynard Keynes. I think it was 1936. And I don't know whether it's chapter, I think it's chapter 12, but whatever it is, he describes what markets are all about in 1936. And he describes something in beautiful prose that explains why the whole country in March of this year was sitting around trading Occidental in some crazy way that enabled us to buy a quarter of what wasn't owned by 4 other institutions that weren't going to sell. We were able to buy a quarter of it, and we could have bought a lot more. I mean, you just wondered if there was anybody that really was thinking about investment. If you going back to investing, I mean, investing is laying out money now with the hope of getting back more later on. It's really laying out purchasing power now with the hope of getting more purchasing power back. But that's the reason that's the way you learn in the textbooks, that you defer consumption now so you can consume more later on so that you can take care of your family. All these things about how investment takes place. And that is what happens with farms. I mean, somebody buys a farm and they hope to leave it to their kids, or they got it from their parents. And I mean, they don't sit there every day and get quotes 15 times a day and say, I'd like to get a call. I'd like to sell a put on the guy's farm next to me, and you can have a call on mine, and then I'll have something called a straddle or a strangle or whatever it may be. And they go about making the farm worth more money, and they do the same thing if they got an auto dealership, and they do the same thing, if they've got an apartment house, they look for improve it and attract tenants, all those kind of things. And 40 trillion at least, of the ownership of all of the American business. People treat as poker chips, or pulling the handle, and they've got systems set up so that if you want to buy a 3-day call on a stock, you can do it, and they make more money selling you calls than if you buy stocks. So they teach you about calls. Nobody's going around selling calls on farms or anything of the sort, but that's why markets do crazy things, and occasionally Berkshire gets a chance to do something, and it's not because we're smart. It's because the only thing I'd say we qualify on, and sometimes I wonder about that, but I think we're sane. I mean, and that's the main requirement in this business. And anybody, Charlie? Yeah.
Well, I don't think we've ever had anything quite like what we have now in terms of the volumes of pure gambling activity that go on daily, and the people lathering the gamblers up so they can rook them. And it's not pretty, and I don't find it creates any great glory for capitalism or anything, any more than a bunch of people throwing dice at a table. What good does that do the rest of the world?
It's a great way to become rich, though. Just figure out ways to insert yourself into the system somehow. And jobs to some extent self-select. And many years ago, and I've got all kinds of friends in Wall Street. Not as many as I had before I had started talking this way an hour or so ago, but I really do. People make lots of decisions in life, and the truth is that overall, the American system has worked extremely well. It may be very unfair in many ways, but it has produced incredible difference in the goods and services available to me versus what my grandfather had available. I do not want to go back to pre-air conditioning and people pouring whiskey down me while they drill my teeth or something of the sort. I mean, this is a lot better world, and
I think we've made more because of the crazy gambling. I think it's made it easier for us, net, over the decades we've been operating.
Well, I mean, we've depended on it.
Yes.
I mean, we depend on mispriced businesses through a mechanism where we're not responsible for the mispricing of them. And overall, we learned something a long time ago that doesn't take a high IQ, doesn't take anything. It just takes the right attitude. Well, we may talk more about that later, but I think we ought to prove that we've got an audience here by going to section 1.
Good morning. My name is Ole Pollem. I live in Hanover, Germany. This is my first time in Omaha. My question is on Berkshire buying entire companies outside the US There were a few, Iska probably the first one, Louis in Germany. My question is, would you only answer calls from them if you're interested in, or would you proactively approach them if they would like to sell their company?
We actually made a few trips. I think maybe Charlie went with me on one of them. We tried to stir up interest and all that sort of thing in Berkshire around the world. We probably did that 20 or 25 years ago. During that period that I showed you, that burst of action we had, we probably spent at least $5 billion of that. Yeah, it'd be pretty in the area of $5 billion of it. We bought 3 German securities. We bought 2. We bought 1 Japan. We rounded up on some of the holdings we already had there. We would love to buy it, but they don't think of us as quickly there. I mean, I don't have somebody that's going to send me an email about a company that I've been following for 60 years, and I know I can see him in New York, and I can name a number to him, and if he likes, he can take it to his board and so on. And it just doesn't happen that way. We haven't had that experience in anywhere outside the United States. Now, you can say with 40 trillion here, we should be able to find something here a little closer to home. But we don't have any bias against doing it. There are companies, we'd buy in 10 minutes if we had somebody on the other end that could do business in 10 minutes. It's much more complicated in certain countries than in the United States to purchase businesses, and there's certain rules. But I would say this, we got a call, whatever it was, many years ago on our company in Germany, and actually the two fellows that run it are probably here in the audience. I saw them yesterday, and they're marvelous, and they run the business, and they're as trustworthy as all the pictures were up on the movie we showed before the meeting started here. We have so much trouble finding good ideas that we can't afford to ignore any, but they do have to be sizable now. I mean, there really isn't. There isn't a lot of. I love the operation we bought in Germany, and it's just a pleasure to be associated with the people there. I just wish we could add another 0 to all the figures, and it was a much larger deal. It's not going to have an economic impact on Berkshire, but they love it. They care. You can see it. You can feel it, and that's the kind of business we'd like to have, and we're very happy we've got it in Berkshire. But we can't do it one debt of Louis at a time, and we would never sell an operation like that, ever. I'm looking at you, Greg. If we get a call tomorrow, and we could make a deal that involved $10 or $20 billion that was in Germany or France or Britain or Japan or name a whole group of countries, we'd do it. We bought the interest in the 5 leading trading companies in Japan a couple years ago, and I rounded them up a little bit, but I told them originally we weren't going to buy a lot we weren't going to change our positions materially without their okay. So we actually, I think, rounded the 5.85%, based on the latest figures we had then, of all 5 of them. And that put a good many hundreds of millions, or maybe $1 billion or $2 billion, to work. So we will, President Kennedy said, we'll pay any price, climb any hills, whatever it may be, to find businesses. But we actually prefer it when they fall into our lap, like getting a letter from somebody and you hadn't heard from them for a couple of years, and you know what you pay for the business, and you know if the board of directors of that company regards it as attractive, that they'll be happy to buy it, and they know you're going to show up at the closing and that you're not going to pile debt on it or change things or anything. They've got an answer, and then you have to see if they've got the question in their mind is what's the best thing for Allegheny Corp. And in that case, we had $11 billion less at the end of the day, or the end of the dinner, than we had at the start of the day. So opportunity can be any place, and we do have a terrific operation, for example, in Israel. I mean, just terrific, and it's pretty good size. Would we like to have another one like it? Yeah, I just don't know what the other one is. Charlie?
Well, but think in the scheme of things, imagine buying in $60 billion worth of our own stock. We like the businesses. We like the price we're paying. No overhead, no cost, no nothing. Just more interest in what we already own. It isn't that we're totally wasting our time.
Yeah, and if you look at it, you can read hundreds of thousands, maybe millions of words written on stock repurchases and what this is and what that is and all this kind of thing. It's not very complicated. I mean, if you had a partner in a lemonade stand and they wanted to sell their interest, or 2 partners and one wanted to sell their interest, I mean, and the business had the money to buy it, our little lemonade stand, and they were offering it a price that was good for the other 2 people that are going to remain, you'd buy it. Now, the thing that is fascinating to me is what you can accomplish, and still, people don't pay any attention to it. We owned, in 1998, this is more than 20 years ago, we owned about 150 million. I don't know whether they've split, whatever it is, if they've split it, split adjusted, but we owned 150 million shares of American Express. I think we bought our last share in 1998 or something like that. So, and we then owned 11.2% of the American Express company. Wonderful company. And since then, they've sent us a check every quarter as a dividend. And so we've taken some cash a little bit as they've gone along. And now we own 20% of American Express. That's what's happened because they've repurchased shares. That happens to have worked out extremely well. If they overpaid for the stock and all that, it doesn't solve every problem, but it's a wonderful thing if you've got an asset you like and they take your ownership interest up. And like I say, we've gone from 11.2% to 20%. If you're using your American Express card, or whatever it may be, 20% of whatever earnings are attributable to our interest, and they used to be 11.2%, and we've done it without putting up any money. Now, imagine if you owned a farm and you had 640 acres, and you farmed it every year, and you made a little money on it, and enjoyed farming, and somehow, 20 or so years later, it had turned into 1,100 or 1,200 acres. I mean, you'd say, how long has this been going on? What could possibly be is this un-American or whatever it may be? I mean, is it sensible use to meet its cost of capital? Blah 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 blah. And if you do it at the right price, there's nothing better than buying in your own business. I mentioned used Apple as an example of how our interest in Apple, every time a company that earns $100 billion a year, it means that our interest in it goes up 0.1%. We've added another $100 million to earnings. Well, it takes a lot of work to $100 million to earnings. And in the first quarter, they just reported, they're on a fiscal year, but they just reported their March quarter, and they earned more money, and they had fewer shares outstanding. And we actually bought a little more Apple in the first quarter. So we decided we wanted to own a greater interest. And on top of that, we knew that we would own an even greater interest if they kept buying in their shares, which we didn't have any insider information or anything, but certainly would seem the way to bet. And, we feel better because we bought the shares we bought in the market, and we feel just as good as by the fact they use their cash to buy out some of the other people. It is the simplest thing in the world, and then I read all this stuff. It is unbelievable how people can't figure out something that, if they owned a farm and the guy next to him had a farm, and somehow you were getting more of his farm all the time without putting up any money while you farmed your own farm, that at least if you're using some of the earnings for that, you'd feel very good about it. Have you got any explanation for it, Charlie?
Well, I have another thing that interests me in the present scene. We get all these suggestions from index funds, a letter saying the chairman and the president of the chief executive officer are the same person, and that they have some professor somewhere that thinks that American business would work better if it had a separate, if Warren could split him in two and have each half work. And to me, it's the most ridiculous criticism I've ever heard. Odysseus would come back from winning the battle in Troy and so forth, and some guy was saying, I don't like the way you were holding your spear when you won that battle. It's some guy that's never run any business and doesn't know anything. I don't think too much of this activity.
Well, let's see. Somewhere in here, I may find it at some point. Oh, here it is. We wrote in the annual report that in the third paragraph of a 9-page report, we said, we're going to treat everybody the same. It may be a crazy concept we have, but we really feel that somebody that gave us their savings in 1960 or 1970 or 1980 and just left them with us and trusted us, we feel that they're entitled to the same sort of respect and attention that somebody that is accumulating like crazy assets under management gets paid based on assets under management, that knows that they just need to have policies that essentially are popular in Washington. The only threat they have really is that Washington sometimes says that you're getting too damn big and we're going to do something about you. So they try to be very sure that they're doing things that people will share. So anyway, I say, well, we're going to treat you all alike. We've got 3 million people or shareholders out there. We're going to treat you all alike. And on March 25th, about a month after I wrote that letter, it's in the third paragraph. You'd think that they would get that far. They had 101 million B shares. I mean, somebody ought to read to the third paragraph. But anyway, we got a letter and says, we would like to meet with you in advance of Berkshire Hathaway's 2022 annual meeting of shareholders to discuss Berkshire Hathaway's perspective on governance and sustainability. Well, I've written probably more on that that's been honestly written by the guy who runs the company, but why in hell would they think that we should meet with them and not you people all individually that come here? I mean, it's, I grew up in a very, very, very Republican household, but I feel like some raving populist or something. But I just can't imagine. Well, anyway, you've heard it. Somebody gets paid to well, there's a lot of people, I'm sure, in public relations, and they hire advisors because it looks better if they have advisors that tell them whether the chairman and the CEO should be the same person or not, and those people get paid for it. And then they discuss it at their board meeting, and then, in the end, believe me, if 90% of Congress for some reason felt it was better to have the chairman and the CEO be the same person, the index funds would not be writing those letters, because all they have to worry about is whether, for some reason, people start wondering why some institution should have 10% of the votes in every major corporation in the country. And I like the idea of index funds, but it is interesting to watch where incentives and bureaucracy and whatever it may be lead people. The guy that wrote me the letter is probably a very nice guy. But that's his job. And well, anyway, they didn't get a special meeting. And you people are here, and we appreciate the fact you're here. Okay, back to Becky.
This question's for Ajit and Greg. It comes from Ben Nall, who's a shareholder of 30 years. He's a Nebraska native, and he says he'll be attending the meeting here today. BNSF and Geico appear to be losing ground to their two primary competitors, Union Pacific and Progressive. Over the past several years, UP's operating ratio has been about 400 basis points better than BNSF's, and Progressive has grown faster while maintaining a lower combined ratio than Geico. On an operating basis, UP's precision scheduled railroading and Progressive's Telematics appear to have jumped ahead of the Berkshire businesses. He wants to know what Greg and Ajit are doing to address those business challenges.
Okay. Thank you, Becky. Let me just start by saying when we think of BNSF, we have an exceptional franchise there and a great business. And we do compete with other railways, and we're very well aware of how they operate, including their operating ratios and the metrics they operate to, and precision railroading, and it's all part of it. But what I would share with is when I think of BNSF, we start with focusing on our customer, understanding how we can best service them, and yes, we want to do it in an efficient, effective way that delivers great results back to our shareholders, and that will continue to be our focus. So yes, we learn from all the metrics they report and how they operate their rail, and we observe it. But I would put our team up right beside them on any operating day, and we're gonna move our rail cars as well as any other rail company in America, and we're gonna do it on behalf of our customers. So we're very proud, but we're not ignoring the fact that there's more to be done, both operationally and for our customers. So we'll continue to see improvement there. We've got a great leadership team there. We've got a great employee group within BNSF. And what I like is we're just gonna see long-term improvement there. We have an exceptional intermodal franchise out of the West. It's incredibly valuable to our shareholders long-term, our partners. And that's what our team is focused on, building that franchise out. So couldn't be more proud of where we're at, but we also know we have a journey ahead of us, and we're gonna continue to get better and better.
Greg, if we were offered the opportunity, would you trade our operation for theirs?
Never. And we love
He knows a lot about it, fellows.
we have a great franchise, and we have a great leadership team running it. So, well said, Charlie. Thank you.
And I just, before we go to Ajit, and Greg, was a major partner for 20 years, more or less, since a little over that, since we bought the energy company, and his boss was Dave Sokol, and the two of them, I mean, they knew how to run businesses. I mean, and it isn't like we don't read what other numbers are and all that, but we've got the perfect person running, and Katie Farmer, we've got the perfect person running the NSF, and she'll do a great job, and it changing around a railroad in various ways. If you got 1,000 or something miles of own track and all kinds of other, it doesn't count sidings and double tracking, and you've got a lot of things to do from something that they started building a couple of hundred years ago, and you, not quite a couple hundred, and you can't move things around very easily, and towns grew. When you came into Omaha in 1862, well, the railroad didn't even go across the river. I mean, even though we'd become a major rail center for the West, or the opening to the West, and we're going to be here 100 years from now. We will be a really vital asset of the country, and it will be a very big part, very important part of Berkshire, and we will take what is an incredible assemblage, I think, of 300 and some railroads or something over time, and the trucks got laid, and the routes laid out. 150 years ago, the world changes, but we have to adapt to it. But you don't put an order out to change 1,000 miles of track and how it's operated or anything of the sort. So we're running it to have that asset for Berkshire shareholders, and it will redundant to the benefit of the country. And if we do it, well, no matter who ran it, would be important. Obviously, enormously the country, and the UP will be here, and at that time too, and it'll be a better railroad 100 years from now than it is now. But I can't promise you what will happen if we get flooding and something in the next few months. It can wipe out a lot of the plans you have, and disrupt lots of lives, and disrupt lots of shipments. And there are no magic wands in railroading to make great changes. On the other hand, you ought to be working at it every day to make it better. I forget how many bridges we have, but some years ago, we were spending $3 or $4 billion a year on capital expenditures. And I said, Matt Rose, I said, this is a lot of money to spend, keeping up a railroad. And then he said, well, we're going to have to do that and more, and so on. And I said, I can handle this, but I'm not sure Charlie can. I mean, I have to explain these numbers to him. So the next bridge they built, they called the Charles T. Munger Bridge. So you can actually go see. Our railroad has the Charles T. Munger Bridge because Charlie kind of was asking similar questions 10 years ago. Ajit?
Okay, thank you, Becky. There's no question that the personal automobile insurance business is a very competitive business. Having said that, both Geico and Progressive are two very successful competitors in this segment. Each one of them have their pluses and minuses. But having said that, there's no question that more recently, Progressive has done a much better job than Geico, as you point out, both in terms of margins and in terms of growth rate. There are a number of causes for that, but I think the biggest culprit as far as Geico is concerned, and again, you rightly pointed out, is telematics. Progressive has been on the telematics bandwagon for, I don't know, more than 10 years, probably closer to 20 years. Geico, until recently, wasn't involved in telematics, and it's been only the last 2 years that they've made a very serious effort in terms of using telematics for segmentation and for trying to match rate and risk. It's a long journey, but the journey has started, and the initial results are promising. It'll take a while, but my hope and expectation is that hopefully in the next year or two, Geico will be in a position to catch up with Progressive in terms of telematics, and hopefully that'll then translate into both growth rate and margins.
Charlie, you got it? It's very interesting. I mean, the auto insurance industry is a fascinating one to study. In that the largest auto insurance company now, and we're talking 2022, and Henry Ford. I mean, it was 1903, or something when cars really got started, and it wasn't too many years after that he was turning out 2 million cars a year. Imagine that, one guy, 2 million cars a year is a lot of cars. So car insurance became very important after hundreds of years of when people thought about insurance. It was ships at sea and fire, where they had protective societies, and insurance as a product's been around a long time, but auto insurance has been pretty much the same thing since Leo Goodwin started Geico in 1936, and we came along with a good idea and lots of big companies and all that. But the largest auto insurance company in the United States was started over in Illinois by a guy who didn't know anything about insurance particularly, and it's a mutual company. It's not supposed to succeed in capitalism. I mean, if you go to business school, they teach you that only because you have incentives and compensation and all kinds of things can a company succeed. Well, nobody's really gotten rich off State Farm. They've sat there, and they are the largest insurance company. While Leo Goodwin started 80-some years ago, and he probably wanted to get rich, and probably at Progressive, people wanted to get rich, and at Travelers and Aetna, and name off dozens and dozens of companies. And who wins? A mutual company. In terms of present size, they still are the largest company. They have, if you leave out Berkshire, they got the largest net worth by far. I think they've got 140 billion or something like that of net worth. And Progressive has had a very, very, very smart guy running it for a very long period of time. They got very smart people running it now, but they have a net worth that's 1/6 that of what some people over in Illinois that nobody knows the name of have after years of, they've had the time to sell the same product, and they advertise like crazy. We spend $2 billion a year telling people the same thing we've been telling them for 70 or 80 years. The policy doesn't change, but when we get all through, State Farm's still doing more business than anybody, and it shouldn't exist under capitalism. If you went there with a plan to start a State Farm today and have it compete with Progressive, who would put up the capital? I mean, a mutual company that you're not going to get the profits from, it doesn't make any sense at all, except they've got 140 billion or something like that of net worth. And Progressive, I don't know what their net worth is, but it must be somewhere around 20 or so billion. I haven't looked for a long time. their net worth in the first, incidentally, I mean, they are very, very, very disciplined in underwriting. And of course, on the investment side, their net worth dropped in the first quarter because they own a lot of bonds. And they say, well, probably everybody in the insurance business would say that, well, we own bonds because that's what people do. And here's half the business where you do what people do, and the other half of the business, you spend all kinds of time trying to analyze in every county and every single way you can segregate and properly rate business and all of that. And I basically, Peter Lewis sat in my office 40 years ago, and he's smart as hell. And this guy was clearly going to be a major competitor of Berkshire's, and he knew insurance backwards and forwards and very bright and everything, but he just ignored the investment side, and that was as important as the underwriting side. And it is interesting how organizations function, and going to have what I would say are, to some extent, blind spots. And of course, Charlie and I know we've got all kinds of blind spots ourselves. So we have to be kind of careful of criticizing other people for having them. But the auto insurance business ought to be studied in business school, because it essentially refutes so many of the things they're presently teaching. So that's my suggestion today to business schools. Okay. And thanks, Ajit. Ajit is responsible for adding more value to Berkshire than the total net worth of Progressive is. That's not to knock Progressive. I'm just saying one guy. Okay, station 2.